G'day and welcome to another episode of SidekickTV. Today I'm joined by a friend, Rupert Gough, CEO of Mortgage Lab and commentator on OneRoof. Rupert and I have known one another for years. We had a few mutual clients, but given that we've been in different cities, Rupert being based in Auckland and I'm in Christchurch, as we're now in the same city, thought it'd be great to throw together a video. And with Rupert's expertise around property and lending, we wanted to give you an update today on what's going on in those spaces. So thanks very much for joining me, Rupert.
Welcome. Yeah, good to be here.
Excellent. Hey, so first of all, in this update, can you tell us what's changed in property and lending in this last year?
There's so mued that has changed. We could probably talk for an hour on that alone, really. So the big ones for investors are the triple CFA, which basically turned the tap off the banks, right? So it came in officially 1st of December last year, but was kind of implemented from about the 1st of September. You would have felt that kind of creeping in. And there's a big long story about why it was there. It was sort of around reducing those really sharky lenders, the third tier kind of 30% per month kind of lender. But the banks got caught up in it and they are liable if they are deemed to be irresponsibly lending. And their response to that, and it wasn't unreasonable, the directors of the banks are on the hook personally for hundreds of thousands of dollars. And so they basically, unless you were a super clean client, they couldn't approve your mortgage. And to the point where, so we're mortgage brokers. At one point a bank told me that all the applications that were approved at the mortgage broker level, so mortgage brokers had said, yeah, this will work, sent it in, they were declining 70% of those at one point, right? So tap is off. That was the big one that most people will have felt, and that's kind of where you start to see that sudden drop off a cliff. No one's turning up to open homes anymore and things like that. So that's the triple CFA. Along with that, as you'll know, came inflation and therefore interest rate rises, and with that comes the test that the banks do for whether you can afford a mortgage in the future, the servicing rate. So that was previously 6.5%, and for those people who maybe signed up for a new build property a year and a half ago, can I afford it? Yes you can, here you go. Now that's been tested at 8.5%. The same lending. So that is another big change, right? So
and there are a number of $1 million mortgages out there, aren't there, at the minute? So we're talking $85,000 a year post-tax just for interest.
Yes, yeah. Before you put in principal and all those other things. Funnily enough, interest rates have gone up more than that. So the servicing rate's only gone up by 2%. The actual interest rate has gone up by 3 or 3.5%. But that's how they measure it. So yeah, it's and those are probably the two big ones. You will know this better than I will, but interest rate deductibility, would that have been the last year? That might have been a bit further back, right?
Yeah, for rental properties, it's a staggered approach. So year one,
sure,
couldn't claim back 25%. Then it's 50. Then it's 75.
Yeah.
Of course, major skeptic in the room, I apologise. This is going to be passed on to the person living in the house.
Yeah, of course. Yeah, well, it has to be, right? Someone has to pay it, and that person is going to need the money from somewhere. So yeah, and that is the horrendous truth of it, I think. Of course, so we could get into a very interesting conversation about two-tier pricing then, because builds are exempt from that. From a lending perspective, the banks have now split rentals. So if you bought it after 20th of March 2020, I think, would that be the right date? Then they'll only scale it by this much. If you bought it before that, they'll scale it this much. So it's pretty horrendous in terms of calculation. But another thing that has affected the borrowing capability of investors and home buyers in general, to be honest. So yeah, it's been an emotional year. To bring it into a positive sort of subject, a year ago, people turning up to open homes were saying, I'm competing against 40 other people and 30 people raised their hand at the auction room. I wish auctions were a bit quieter. I've got good news for you. They're real quiet now. So if I guess basically, and I'm probably jumping ahead a bit, but if you can buy at the moment, you're never going to get that. You know, we all want to buy at the exact bottom of the dip. Yeah. You're never going to do that unless you're super lucky. But if you were looking for that time to buy, I would say that's now, right? That is, if you can get in when there's only one other person in the room in the auction, you know, talk a reasonable price to people, be part of that problem that's bringing down prices, you know, be the one that brings it down, the local statistics. That now, you're not going to get a better time than now, right? Yeah. Because as soon as things start getting up again, people are going to return to the market.
Totally.
Yeah.
I was talking to a real estate agent just recently, and he said that you'd always say, you know, the best time to buy a house was always yesterday.
Yeah.
Right? Now, I agree with the sentiment, but not quite exactly. So, yes, yesterday, but if we are in a downward trajectory of house prices, maybe technically in 6 months' time is the best time to buy.
Yeah.
But can you borrow for that house in 6 months' time?
Yes.
I think I would echo what you've just said. The best time to buy is when you can.
Yeah, I actually wrote an article on OneRoof quite recently about that because they announced that, you know, in the last quarter, house prices have dropped by 5%. And I ran the calculations, and there were people who could afford a house 5% higher, but now can't afford that same house 5% lower in price because the servicing rate's gone up so much.
Yeah.
So if they were waiting for house prices to drop, they've lost the ability to buy that same house. When they could have just had it, sure, it would have dropped by 5%, but unless you're flicking it, then that's not an issue. Yeah, so it is a crazy world at the moment. There may be some opportunity, and we're seeing this a little bit of, so those people that sign up for a build a year and a half ago, now starting to come to settle, can't settle. The bank says no. So if you are cashed up, ready to buy, there may be some developers or who have stock that was signed up for and isn't. So
what pain are those people going to experience?
It will vary from developer to developer. Some will say, okay, well, honest attempts to kind of sell it, and any losses you have to swallow. I mean, if you sign up for a year and a half, you've got probably a year of capital gains, a cushion in there. So, but some, I know a few developers who are just like, look, that'll be our problem, don't worry about it, kind of thing. So it really ranges from developer to, I suspect you could probably get a good indication of how solid the developer was from how they responded. If they're kind of, you know, stealing their deposit and things like that, then yeah, you might want to look more into that. But yeah, it will range, I think. Yeah, there won't be a set rule, but there's certainly some opportunity again for some developers, for some buyers to pick up newly built house, which has significant tax advantages, obviously, also significant borrowing advantages in terms of the loan-to-value restrictions. You can borrow more, you don't need as much deposit, that kind of stuff, as well as, you know, the interest rate deductibility and ongoing things like that. Yeah, absolutely. So new build. There's some opportunity there for sure.
Yeah, fantastic. And you're probably helping someone out of what could be otherwise a very sticky situation. Hey, we're talking if they can't settle on a house they've committed to, the bank won't lend them the money. They really need a queue of people coming to pick up that house.
Absolutely. Well, there'll be a bit of a trick there, and this is not tax advice, purely from a bank perspective, right? You would want them to forfeit that house and buy from the developer, because the loan-to-value ratio restrictions apply only if you're buying direct from the developer. So if they're selling it to you with a bit of a profit, which they would want to do, you're not going to get those exemptions there. And
I think that's the same as well. But again, I'll clarify the ruling in the comments. But if you're not the first owner of the house, it's not potentially a new house anymore, so you may not get the tax deductibility from it. So I'd like to say that in this video there is no personalised tax or investment advice.
So just did that earlier, shouldn't we?
So all right. So That's that's fascinating. I wasn't even aware of this kind of potential wave of these houses that might not settle as they were originally intended. But so that could be some pain there. But tell me, what are your smart clients doing now?
Yeah, well, I think it goes back to that. And look, it's not a predatory kind of practice, but those ones who are cashed up, they are taking advantage of this. So if you can kind of take a deep breath and remember what it was like for the past couple of years in terms of open homes and buyers. So I live in Tauranga, but I spent 5 years in Auckland, so I know what that market is like. If you can just kind of have a minute and compare today versus 2 years ago, I think you would find that this market is a very good market to buy in. You're going to pick up some opportunity there. I suspect that the majority of your clients are long-term holders. We're talking long-term holder investment residential buyers. It's not going to matter if you buy it and it goes down another 3 or 5% because over 20 years that's not relevant. So I think they're using this opportunity to pick up some bargains without the competition.
And looking more so at the fact of availability of stock rather than, I'm not necessarily buying this at the absolute bottom price it might ever be, but I can buy it now, so I will. Is it that mentality?
Basically, yeah. And of course we're starting, that isn't solved yet as of today, but the logistics around building supplies and things, it's getting a little bit better than it was again 6 months ago. So they're starting to get those completed houses. So yeah. I did have something else and it's totally gone from my mind. Yeah. No, that's right. I mean, look, it is a great time to buy. Probably one thing is just to think about, we're heading into summer now. So typically we see a rush of people buy before December. My guess is that in terms of interest rates, you may see, let's say today we were seeing about 5.15. We saw a dip to below 5%, and we're just seeing a couple of banks pop up above that line again, the 5% line. It wouldn't overly surprise me if you saw a 6%. And some point. So when I should clarify, I always talk about the 1 year fixed rate because that's the most interesting one that everyone uses. So the 1 year fixed rate popped below 5%, just kind of raising its head above there at some banks as of today. You may see a 6, but it would shock me if you saw a 7 there. That something has gone fundamentally wrong with probably inflation there at that point where they would have to raise the OCR significantly higher than forecast. Of course, there's always international issues that may pop up. So those people that were holding back, worried about remembering 2007, kind of 8 or 9%, it doesn't seem to have that feeling anymore. In the economy, they've got a lot more levers than they had because in 2007 they only had interest rates really. Now they've got loan to value ratios to call the market and all sorts of things like that. So yeah, I wouldn't hold it. The smart buyers are feeling that they can afford. If they can afford 7%, they're probably not going to see that. So they're jumping in regardless. In terms of the summer buying, for investors, renters do the giant shuffle around in January, so you'd want to be kind of buying before that happens would be my suspicion.
Yeah, picking up a rental property just post that, if it's empty,
it's empty for a while.
Gonna stay there.
Yeah. And I'm always a little bit frustrated with the media or commentators about it's July and there's the rental market's really down. Well, it's always down in July. It's winter, no one wants to move. So and all the students are busy with exams and things. So I'd like to see a comparison of January versus January. That's always that's always a good litmus test, right? So.
And is actually this would be useful for perhaps people that are less in tune with the market. Is that historical information available anywhere? Do you know, like the availability of rental properties, or?
It's not a metric I
No.
track. I'm more of the mortgage-based sort of side of things. I'm not sure. There may be.
The reason I mention it is just, we looked at when we're talking with our clients and they're thinking about buying a rental property. The first thing it's all well and good having a rental appraisal, but then it's like any business. It's like, are you actually going to sell it? Are you actually going to sell it at that price? Or rent it at that price? Because if it's a 2-bedroom house in Christchurch, townhouse or what have you, do a quick SWOT analysis. Look what your competition's doing. We did a search the other day here in the office, and I think I saw 130 2-bedroom houses for rent at the moment in this area, right? So make your decisions from that, you know.
Yeah, you'd have to have a point of difference, wouldn't you, at this time of year to be getting in there.
Yeah.
No, it's. I think my guess, if I had to put my money down, and you can feel free to write to me and tell me that I'm wrong later, would be October is you're going to start to see an uptick in interest. Interestingly, talking of metrics, so I track the mortgage volume statistics which come through Statistics New Zealand and RBNZ, and this time last year we were kind of lending out $10 billion a month. Triple CFA hit and it fell off a cliff, right? It fell by 50%. But if you actually pull up the table that shows you the past 10 years, 5 to 6 billion was the norm. So actually, when it fell off a cliff, we kind of just went back to how it was. 5 to 6 billion is just what we've been doing, and it's quite a flat line, right? For years and years, it just feels like, compared to last year, it was dead quiet. But things are turning over. The market is turning over, and so don't think that it's dead in the water. There's plenty of opportunity out there.
And there's a lot of that return to trend that actually is really reassuring, isn't it? It's the same for house prices. Actually, nearly always they return to trend. So,
Well, I mean, and for investors and home buyers and mortgage brokers specifically, the mortgage and finance world is very deadline orientated. You've got to have a finance date by this, you've got to have a registered valuation by the state. And this time last year, the banks would take 10 days to tell you that they needed something else, and then 5 days to say, oh, that wasn't quite the right one. So we wouldn't want those days anymore, really. So now they're kind of back to quick, 2 days to reply. So it's a much nicer market to dwell in from both sides, the client side and from the broker side. So but it's still going. It's a great opportunity right there. Yeah.
Excellent. No, that's fantastic. Hey, thanks so much, Rupert. I really appreciate your insights on this, and I know that we really heard the wisdom of an expert here. So thank you so much. And thank you very much for watching, guys. In the comments, I will post the link around that tax bit that we spoke about in terms of transitioning from developer or purchaser, yes, thank you so much. And do remember, there was no tailored financial or tax advice for you in this video. Cheers, Rupert.
Cheers.
Cool. Thank you.